So welcome to today's webinar on blended finance for climate action. I'm going to introduce our speakers in a moment. I just wanted to start by reminding everyone that we are recording today's session. It will be shared with participants after the webinar, and we will also post it on Eurodad's website. In terms of how the webinar is going to be run, we're going to have two presentations, and I will soon present the speakers, but also to make everyone aware of the chat functions. So we have a Q&A box, which should be more or less in the middle of your Zoom screen where you can ask questions. But we ask you to also keep the chat function open because there will be some links and information pasted there throughout the webinar. But as I said, please do ask any questions that you have in the Q&A box as we go along. And with that said, I would like us to start by introducing today's webinar. My name is Anders Dahlbeck, and I am a program manager for climate justice with ActionAid Denmark. We have been working with Eurodad on blended finance for climate action in recent months. It's a very topical issue. A lot of governments are thinking about how they can use their finances to leverage private finance, and I guess we felt that it needed some further examination whether this was a good value for money. And so, as some of you know, we earlier this month released a report, and I'm very happy that we have the author of that report, Farwa Sial, with us. Farwa is a political economist and works as a senior policy and advocacy officer at Eurodad. So she will present the main findings of the report that she has written, and will of course also be available for questions and clarifications from participants. We also have the pleasure of having Dr. Basani Baloyi with us. So Dr. Baloyi is a development economist and program co-director at the Institute of Economic Justice. And Basani's interests are in the realm of financing for development, feminist economics, and just transitions. And Basani will also provide some more practical examples of what blended finance and climate action has looked like so far in practice. So we're going to start with the presentations, and then we will address any questions afterwards. But please do type your questions in the Q&A box as the presentations go along. And with that, I'm going to hand over to you, Farwa.
So hi everyone. Thanks a lot for the introduction, Anders. And I just wanted to add that the report with the same title is out on the website now. And as we go along, Stephanie will also, our colleague Stephanie will also put in some links on the chat. This is also the second webinar on the subject. We had one webinar with a diverse set of panelists in November, and today's webinar is about raising awareness, raising interest, and also having a discussion amongst ourselves. So what I will do is I will speak for about 15 minutes on the topic, and I will start with the brief introduction to the concept, followed by key trends of blended finance and climate action. I will move then to risks and opportunities and conclude with the 5 policy recommendations that we identified in the report. Next slide, please. So let's start with what blended finance is, and it can be broadly defined as the combination of public concessional official development assistance with private or public resources, generally with the aim of mobilizing or leveraging development finance from other actors. So blended finance is one of the instruments of private finance and is part of what is commonly referred to as a de-risking agenda, in which the risks of the private sector are mitigated through subsidies to then attract private finance for different developmental and climate action programs. So the image on the right is a very basic example of what blended finance entails. And the background to this instrument lies in some major proposals by the World Bank, most of which are, you're very much aware of by now. But these were encapsulated in the 2015 and 2017 reports, which were titled Billion to Trillions and Maximizing Finance for Development. So in the post-2008 global financial crisis context, these reports were promoting a series of instruments to accelerate the flow of private finance through public subsidies and providing these so-called innovations and de-risking agenda. But the important thing to note here is that as a concept, blended finance does not have an officially shared definition. So we highlight this in the report, and if you just compare 3 different reports by 3 organizations, for example, the International Energy Agency, the OECD, and the European Commission, each definition varies. So this means that there is a significant impact on how blended finance is reported, how it's evaluated, and simply measuring the actual impact or additionality of using private finance through blending becomes very problematic. The main goal is to crowd in or leverage private finance. However, there is no consistency in different instruments, in different organizations about how leverage ratios are employed. So leverage ratios are also not defined, and as a result, blending actually remains a very elusive concept. Having said that, in 2021, the OECD's Development Assistance Committee, DAC, approved OECD UNDP-led impact standards for financing sustainable development, which are attempts to harmonize best practices across development finance institutions. But it's important to note that these are voluntary practices and they remain subject to self-reporting by the organization. Next slide, please. The next one, the third one. Yes. So this is a brief overview of what we discussed in the report. And before going into this, it's important to mention that we use the term climate action instead of climate finance to allow us to cover a broad range of climate-related investments. So beyond specific official and unofficial taxonomies, it's related to climate action more broadly. The trends we identify is, first of all, the amount. So between 2019 and 2021, around $14 billion were invested. And this is a fall compared to $36 billion between 2016 and 2018. So a combination of reasons, including COVID, a fall in demand, and risk aversion by investors in this risky period is a cause of this. A second trend is, of course, who are the stakeholders? And stakeholders include diverse actors which collaborate with each other. So multilateral and bilateral donors, investors, as well as philanthropic organizations, companies, commercial banks, as well as insurance companies. If we consider the type of climate financing, the majority of financing is being provided for mitigation. So between 2019 and 2021, an average of 58% of commitments of blended finance went to mitigation. If you think about the recipients, the largest recipients of blended finance for climate action have been corporates and project developers. So 70% went to these corporations and project developers in 2016 and 2021, which rose to 78% in 2019 and 2021. In terms of regional distribution, over the period of 2016 and 2021, the majority of blended finance investments in climate were in Africa, followed by Latin America and the Caribbean. And the largest proportion of blended finance transactions actually targeted middle-income countries. Low-income and least developed countries continue to lag behind. So this is a consistent trend, not just in the past few years, which means that blended finance for climate is actually primarily targeting investments that generate the most profit. The next slide, please. So blended finance has multiple risks. I'll go through the risks and also look at some of the opportunities that we identified in the report. A first major risk is that blended finance can actually perpetuate climate coloniality. So the projects in renewable and green energy are ultimately a subsidy to investors in the global north, and they are grounded in extraction, and they are likely to perpetuate a race for resources and minerals unless they are regulated properly. A second risk is that blended finance can contribute towards marketization of the climate agenda in the global south. And in both these points, we need to consider the fact that blended finance as a model needs to be considered in the entire process. What is it that blended finance presents? Because the financing cannot be distinguished from the entirety of the process, which is marketization of public services and marketization of the green energy transition in the global south. A third risk is that blended finance often entails debt, so sovereign as well as private debt, sovereign guarantees, and these need to be repaid even if beneficiaries are provided with softer terms. The fourth risk is that blended finance can also lead to a crowding out of domestic financial sector. That means that the scale of investments deters the domestic financial sector to invest in a productive investment. A fifth risk is that blended finance risks undermining a country's ability to have country ownership over its investments in vital climate technologies by prioritizing the interest of foreign private investors over decisions around the most effective climate technology investments. Sixth, blended finance projects suffer from low levels of transparency and have a poor democratic accountability record. Finally, seventh, the main purpose of blended finance has been to mobilize adequate amounts of private finance for climate action. But actually, that's not been the case. So in 2021, the DFIs financed long-term projects totaling only $13 billion. This investments basically has not been enough. The next slide, please. So we tried to identify some opportunities in the report to reform the blended finance agenda as it currently exists. And we came up with 4 solutions. And the first one is that the redirection of external concessional finance to strengthen public finance for climate action in recipient countries. So we have a very good precedent with regional and national public development banks. If they are well governed and well resourced, they can play a critical role in supporting climate resilient infrastructure. Secondly, blended finance for climate is a relatively new area, and there are opportunities to shape the agenda better. So the OECD UNDP impact standards can work towards that goal. Third, blended finance for climate can be targeted to reach local private sector companies, entrepreneurs, and communities that otherwise do not have access to finance. And finally, we note that if blended finance is provided through grants, it can target and support renewable energy infrastructure. So these are some of the findings we identified as key opportunities, but we also have some recommendations. The next slide, please. So we have these policy recommendations, and we had a very long discussion on how to move forward in terms of this agenda, which is right in front of us, especially as just the COP has just ended. And the first recommendation is that the additionality of blended finance for climate needs to be accurately defined to ensure that public finances are not being spent on projects that may have happened anyway. So additionality should be understood both as attracting investments that would not have happened, that is financial additionality, but also positive impacts of such investments on lowering emissions, improving resilience, creating jobs, and not having negative impacts such as distorting domestic financial or technological markets. A second point is that there has to be a need to ensure that all blended finance projects are transparent and include key information on project costs, on the subsidies to different actors, and disclosures on intermediaries. A third point is that blended finance for climate action should not be subject to economic policy conditionalities, and therefore should not force countries to undergo restructuring of legal processes to adjust investor needs. So in particular, this also includes avoiding policy conditionalities that promote the privatization of public infrastructure and services or deregulation, as we actually see in a lot of just transition partnership programs right now. Finally, we emphasize on country ownership and community-led solutions. They should be supported through adequate instruments, and blended finance practitioners should explore best practices and possible approaches in this area. Finally, blended finance must not be used as a financing instrument for the loss and damage fund. The fund is based on the responsibility of global north countries to global south countries, and this should not be distorted using the role of the private sector. So I will conclude with a few lines, which is that blended finance, for it to be an effective instrument, it needs to show efficacy, additionality, transparency, and finally, what we conclude in the paper that this is far from the case. We have two case studies. First, on the South African Just Transition Partnership, and actually, Basani can expand on that, as well as IFC's Scaling Solar Project, which are part of the report and are published separately. And there's a link to those in the chat. So with this, I'll conclude. Thanks.
Thank you very much, Farber, for that. And as stated at the beginning of the webinar, if you have questions, please put them in the Q&A box. We already have one from Karel, which we will address later. But if there are other questions, please continue to post them in the Q&A box. And as Farber pointed out, there are also links to the case studies and some other stuff in the general chat function. But with that, I'm going to hand over to Basani. Please, the floor is yours.
Thank you very much. And thank you, Farwa, for that context setting, and also just congratulations on your excellent report. Yeah, so I've been tasked with just talking about like how this has evolved within the South African context, where a lot of our work is. And if we take the basic definition that Farwa spoke about, right, which is the blending of private and public finance to catalyze more financing for projects. In a sense, blended finance is not particularly new, right? In fact, historically, it has been used as a way, this blending of different forms of finance has almost been used to build up manufacturing enterprises that have created, in a sense, billions of jobs. And I think that the challenge with the use of this instrument today, as we're seeing it play out, is that it is being used to support, as Farwa mentioned, a private pathway in the provision of public goods that were previously the preserve of state provision. And this private pathway is basically aimed at financializing these assets in response to the climate crisis and using the climate crisis to do so. And in particular, blended finance is essentially used as a financing instrument that facilitates the privatization of public infrastructure through public-private partnerships and the financialization of these infrastructure services. So I've been asked, as again, to talk about the South Africa case, and South Africa is a recipient of the Just Energy Transition Partnership financing deal, which is at some point an 8.5 billion deal of committed financing, and that has been subsequently increased to about 11 billion in the 2 years since the announcement. So the JP financing is being targeted mostly at the electricity infrastructure sector, if you look at where much of it goes, which enjoys about 89% of committed JP finance, with a focus on the private provision of energy over the near term. The provision of this energy will mostly be in the form of an accelerated rollout of independent power producers in the renewable sector, which are essentially PPPs. Now, IPPs are highly leveraged assets, and in South Africa, the debt to equity ratios average between 80% to 20%, right? Equity and 80% debt and 20% equity on average to basically produce about 5 gigawatts of energy, which is more than, and this debt equity ratio is actually more than the state energy company Eskom, which produces about 44 gigawatts of energy. So some IPPs have even higher leverage of 95% debt to 5% equity. Now, this leverage is obviously risky, right? If these debt to equity ratios are that high. Now, there are a range of measures that have been used in the South Africa case to de-risk on behalf of the private finance, this level of risk exposure. And one of these measures is first to finance these projects through off-balance sheet financing. They do this by creating separate entities that are not listed on the stock exchange and thus don't have to report their financials publicly, and they make these entities absorb the debt and risks and rewards associated with the projects. Now, these are called special purpose vehicles. Now, private finance is also de-risked by mobilizing public money through blended finance instruments, which support, as I say, the financialization of these essential services. Now, SPVs an SPV would obtain this financing by selling securities to investors in financial markets for a minimum guaranteed return on investment, which is backed by the revenues earned through the sale of energy. Now, in order to pool financing from a broad range of investors, right, with different risk appetites, the project developers will employ a credit enhancement strategy to reduce the risk to certain investors. This will be done by splitting up the security, right, that they sell to investors into different parts. The top part or the tranche is called the senior debt lender, the senior credit, and the bottom tranche is the mezzanine debt. Now, each tranche would represent a different risk and return profile. Now, the returns are earned through the cash flows from the tariff revenues generated once all the costs of the business have been, once the business is operational. And the senior debt lenders are more risk averse and earn lower returns, and so will be the first to get paid out should the project default on its obligations. Now, the mezzanine debt lenders are investors that have higher risk appetite and earn higher returns, and so they will be the last to get paid out should the project default on its debt obligations. Now, these tranches are blended finance, as this in the South African context, as the senior security is actually held by not only commercial banks, but also development financial institutions. And in the South African case, that would be the Industrial Development Corporation and the Development Bank of Southern Africa, which have been very key agents of what we call the renewable energy. It's kind of like the renewable energy independent power producing program, right, which is largely deemed as quite successful in the continent, right? So they will buy into that debt, and the mezzanine debt which is a bit more riskier, is held by Black empowerment SPVs and also community vehicles, which are actually financed by the DFIs, right? So so there is this mix through the way in which the securities are structured of both private and public money. And in this whole security, these two tranches, this whole security is then given a sovereign-backed guarantee, right? So that's another element of this. Therefore, blended finance is, in that sense, a key component of the manner in which private debt instruments are structured. Now, indeed, the presence of public finance at concessional rates or grants or whatever helps to reduce the cost of private sector borrowing to ensure a particular level of profit. But importantly, blended finance is used to facilitate this credit enhancement strategy that ensures that the state takes up the commercial risk of these highly leveraged assets should there be any kind of crisis. Now, blended finance is a key mechanism, as I said, used to create these highly leveraged asset-backed securities backed by the sovereign that can be then traded on financial markets, right? So the profits that these financiers are after are not necessarily the revenues that are earned from the sale of energy necessarily, right? It's not through the tariff that they're making the big buck. The revenues that are made, or the profits that are made, are actually through the sale of, so the revenues made through the sale of energy are basically just a backup, right? That facilitates the real accumulation of even more revenue streams, i.e. the financial rents that are earned through the resale of these securities and like the refinancing also. So blended finance is necessary to basically guarantee these profits, but it's insufficient as it must be supplemented by another de-risking mechanism that ensures the extraction of these financial rents. One such mechanism essentially creates private monopolies of the PPPs. We have demand guarantees, basically in South Africa, that oblige the state company Eskom to pay a set revenue at in fact cost reflective pricing, right, to the IPP. At least that is the push, is that the tariffs need to be cost reflective as part of this JP process, right? So the demand guarantees and through the JP process, the state is meant to pay a set revenue at cost reflective prices to the IPP throughout the lifetime of the contract, which is typically in the South African case about 20 years. And these contracts are inflexible and result in heavy penalties should Eskom not afford to honor them, should there be some kind of a crisis. And in fact, if you know anything about South African energy, we are in a crisis of energy supply. And what this PPP model means, of which the use of blended financing is a key part, is that the public doesn't get the benefits of reduced energy prices, or what I mean by renewable energy prices. They've been going down. The cost of renewables, anyways, have been going down. So we don't get the benefits of those the reduced costs of the competitiveness of renewables from previous bidding rounds, because the Eskom is locked in for 20 years or whatever. So clearly, blended finance is a part of the package of mechanisms that is used to extract financial rents and produce inequalities of access. Now, the reason for outlining the workings of this mechanism is to also address the observations raised by the report that blended finance is mostly geared towards energy infrastructure projects and not, or mitigation projects, and not nearly as much going to adaptation and in our context, also just transition type of projects. And B, that blended finance is not catalytic enough, or at least that is how it is, how it has evolved, especially from the numbers that are in the report. So for the first point on the limited sectorial traction of blended finance, where it's just limited to mitigation, in our case, like energy infrastructure kind of project. The reason for this is that blended finance is used to reduce private finance risk exposure in order to support activities that help to realize a particular level of return on investment. And since adaptation and just transition projects are largely not activities that can help to realize the returns to investments in financial terms, these projects will tend to be underfunded, even if you try to sweeten the deal through blended financing instruments. Now, this is a classic textbook case of some of the features of what defines a public good versus a private good in a sense, right? So this is the feature that public goods tend to be underfunded because the private sector cannot capture the return from investments due to whatever externalities, right? But here, what has happened is that the financial innovation that has been introduced through the use of blended finance and state regulatory reforms that have, and in the South African case that have happened, that have shaped the contracting terms, right, has actually shifted the terrain of what can be considered public versus private. Now, as a consequence, the developmental additionality principle that the report talks about becomes undermined within that context. Now, this contrast is made clear in the Just Energy Transition Investment Plan, which is the only document that actually shows the direction of committed financing, what is committed, not what is required over the 5 years. The bulk of what was committed financing in the investment plan was directed to infrastructure provision projects. And the bulk of which is followed by electric vehicles and green hydrogen, right? And again, a lot of pushback around electric vehicles. Why electric vehicles when we know that this is something, is this really additional? Because this is something that should have happened, that would have been happening anyways, are some of the issues that came up, right? So the electricity infrastructure received around 89% of committed financing, and activities that help to manage the transitional risks in a decarbonizing world or economy. Example, skills development in new sectors and economic diversification received about 0.3% and 0.1% of committed financing, respectively. And there was no flow of financing towards transport in public towards public transport infrastructure. Most of it went to electric vehicles, which again, not as decarbonizing as public transport infrastructure, and not as inclusive as public transport infrastructure. So civil society pushed back against this sectoral breakdown, and the state has responded in the Just Energy Transition Implementation Plan through what I would say is a non-response. The state wants to raise about 84 billion US dollars, which is 1.3 trillion rands in the next, or 1.4 trillion rands in the next 5-year period. And the state has published the numbers for the sectoral breakdowns, revealing where it hopes to direct that funding, right? So economic diversification in the electricity and transport sector has been given quite a bump up in both absolute and relative terms, and skills development has also increased in absolute terms. Now, this increase is to be welcome, and this is after a lot of pushback from us, right? As it helps to manage the transitional risks, but this is what the state's hopes it will mobilize, or it hopes that it will direct funding towards that. It doesn't mean that what is currently committed is, it doesn't mean that there is increases in what has been currently committed as we know it, because these numbers are basically aspirational rather than indicative of actual commitment. Therefore, in that sense, the job creating potential of renewable energy manufacturing sector remains in question. And this is what Farwa was talking about the coloniality of this kind of thing, because the bulk of committed financing is supporting just the infrastructure component, right? And because JIP apportions about 1.6 billion into the localization of renewable energy value chains, right? In terms of what is committed, and JIP apportions, I think it was 648 billion into the electricity infrastructure in terms of what has been committed. So this imbalance will continue the dominance of a highly extractive economy, which we call the minerals, energy, finance complex, where these are the key sectors that have driven the economy and limiting a lot of diversification of the economy. And what we know about that kind of thing is that these are not necessarily job creators, and jobs are very important in South Africa, as we are one of those with the highest in the world, right? And so, okay, sorry, I'm being asked to wrap up. So without the cheap financing that the renewable energy manufacturing generating sector receives to make it competitive, then it will continue to falter, because the IPP sector basically continues to resist any kind of industrial policy measures that impact the cost competitiveness of inputs into the renewable energy generation, because their objective of maximizing profit at least cost. Now, if I'm just to wrap up quickly, and another important point is whether or not blended financing is actually catalytic. Now, the jury is still out on this one. A report by South Africa's National Business Initiative, which is a private think tank that has supported the JP process, says in its report that blended financing is catalytic from a range of 3:1 up until 9:1 ratio, right? Depending on the project, the type of project, and the concessional terms, right? They don't really go into the details of that. Now, the report doesn't say how it comes up with these numbers, right? And as I said, NBI is very key, because they have been the ones that have been the knowledge generator for the task team that has been compiling all of this. And this goes back to what Fadwa was saying around like how these blended financing numbers are actually being generated, and how leverage or catalysm is, sorry, I'm not sure if that's the word, is being measured. But if we can take that but let's take that report in good faith. The issue remains that blended financing, if it is catalytic, as NBI projects, is catalytic under particular contractual terms that basically shift command contracting it's within a particular context of what is commodifiable. And that is, I think, very key to note. Thank you. Sorry about the length.
No worries. Thank you very much. And it was all very interesting. And I'm very sorry that we don't have more time, because I think it could have been interesting to hear actually more from both of you as part of your presentations. But luckily, we'll hear more as well from you now that we have some questions that I wanted to bring up with you. I think we'll actually start with Karel's question, which was around, and it was posted during your presentation, Farwa, so I think it's directed to you. So it's asking if you could please elaborate on the recipients of blended finance for climate. What type of corporations are we talking about? And the geographies of the project developers, just to get a better understanding of that. So we'll start with that question, and then there are a few more.
Yeah, thanks, Anders, and thanks a lot, Basani. I think the points were really very useful in illustrating the South African context in relation to climate, but also looking at the general context of a country which is receiving these instruments, because I think a lot of emphasis is on the instrument, but in a vacuum. You know, it's about deliverables, and I think that's where the instrument is quite problematic. So, yeah, the recipients of blended finance, as I mentioned, 78% of these in the period 2019 and 2021 were corporates and project developers, and these include private companies, hedge funds, private equity funds. In fact, in the links that Stephanie has shared, there is a report on a Dutch fund which has been reported to have really high salaries to shareholders, and hiking up prices for a public service which it is investing in. So this is a direct result of a blended finance investment in the country. In terms of geography, I don't have a breakdown for that, I'm afraid, but we have to see where is the money. If the money was in the global south, I think we would see a higher percentage of these investors maybe investing regionally. But if the figure is 78% in 2019 and 2021, then I think we can safely assume that the majority of it is in the global north. But that's also something to look at. It's really important to distribute geographically, very concretely, who are the investors. I think that was the one question which is directed to me, right? Yeah. Okay. I'll stop here.
Thank you very much. And Anoop, we're going to get back to your question, but I first wanted us to look at a question from Paddy, which is directed at Basani. It's a slightly longer question about South African IPPs. I'm not going to read out the whole question because I think most of you can read it in the chat if you want to. Basani, are you okay to address that question in a couple of minutes?
Yeah, sure. I'll be very succinct. I think what I mean by it, Paddy, from my perspective, is that blended financing is part of a package of de-risking mechanisms that ties the state into long-term contracts at set out prices, even if there has been a competitive bidding process in the award of, let's say, what happens in round 5, right? The point is that the state is then tied into that particular price point for a 20-year period, even though in the next bidding round, that price point will be lower, because with successive bidding rounds, it becomes more competitive. So the state will be tied on for those who are contracted under the bidding round 5, the state cannot adjust that price point downwards to the lower price point under bidding round 6, because of the way in which the contracting is established. And that's because the state has to guarantee that revenue stream, right? And it cannot, and if it tries to, there are heavy penalties in trying to renegotiate with those whom were contracted to generate this energy, right? And so it creates it creates an inflexibility, right? And in fact, the country tried to renegotiate. I think it was between the early bidding rounds where where the tariffs were highly subsidized, because I think at the time the refit program was in operation that basically subsidized these tariffs. And so the state is still caught up in that price point 20 years, however many years later. And so I think that was where I was going with that. Of course, as with more auctioning, prices get lower, but I'm talking about what the state then the way in which the state is locked into particular price points that are as the bidding rounds continue, that it cannot then renegotiate, right? And so the jury is out. Do we like this or do we not? Should it necessarily be Eskom that is providing this, or should we be saying something about the contracting terms? Should the state be locked in for 20 years is another question, right? That could be asked. And therefore, what does that mean for the blended financing instruments? What does it mean for contracting within that? Yeah, thanks.
Thank you. And we're having quite a few questions come through, so I'm going to try also to lump some of them together. So there's something around the options of the South African government, both what they think about how it's currently working, but also what would their alternatives be if they want more investments to expand renewable energy in South Africa. And I guess that also opens up for a slightly broader question that I would like to hear from you as well on Farwa, which is around what should be the considerations and responsibilities also of southern governments in letting these projects go ahead or not go ahead, given the pressure that they are also under to deliver on certain mitigation aspects. But let's start with South Africa specifically, if that's okay for you, Basani, just to share a few words about what the South African government considers to be a success or not of the current model, but also what would the alternative ways be to expand renewable energy in South Africa. And then maybe Farwa, if you could say a few words more generally about the approach that you think that Southern government should have to this type of projects. Thank you.
Thank you for that. I think in terms of what the South African government would consider a success, is that, first of all, we have a climate financing deal. I think to them, that is something that is considered a success. The fact that we were able to get mostly global north countries to commit to about, the 11 billion dollars. I think where another success story that they would have since that announcement is the fact that the grant component has increased slightly. I mean, it was at 4%. I can't remember the number now. It's not large, right? But certainly one of the things that were problematic was the fact that the debt component was very high. Thirdly, they would argue that this is catalytic, right? That what they've been able to do is set the baseline for more catalytic investment, and they are pretty what can I say? They are pretty confident that they will be able to get just under $100 billion in 5 years. Now this is where part of our critiques have been, right, is around using this model, this financing model, to think that these large flows of funds will be catalytic enough that draw in private financing, and this is also where some of what financing alternatives we arrive at particular financing alternatives. Now, in terms of their position that they're going to mobilize all this money in the next 5 years, the issue is that, and we've critiqued this before, is that this basically overestimates or underestimates, I would say, the structural constraints born in the global financial architecture and that are imprinted within our macroeconomic policy that undermines that mobilization of large financing for climate action. And that's because the global financial architecture is still deeply there's a high carbon bias, right? And which is continued even within our monetary policy, right? High carbon bias. Our interest rates, for instance, we don't have interest rate differentials at the Reserve Bank level, which differentiate between what is green and what is dirty. We don't have requirements from the Reserve Bank that says to banks that you need to ensure that you have higher reserve requirements for dirty activities that you invest in, and lower reserve requirements for more green activities. And basically, without that kind of mechanism, you are reliant upon the whims of private sector to respond to your blended financing and the like in a way. So you're not basically directing financing through what you can use in terms of your monetary policy instruments. And that for us is a very key part of this call. But it's not just, and then also you could design your monetary policy instruments in a way that says, we need for basically just transition types of, for economic diversification or transitional risks, you can incentivize, you can produce your monetary policy instruments that help to ensure or force the banks to basically direct the financing in a particular way. And that is not something that is currently happening. And that is a big piece here. So that is basically one alternative. Of course, there's taxation, there's a range of others, but yeah, thank you.
Thank you very much. And I'm going to hand over to you, Farwa. We are running a bit short on time, so I hope it's okay for everyone that we're going to go over by a few minutes. But obviously, for those of you who need to leave, please do leave. But I want to hear from you, Farwa, and then we have a couple more questions that I just wanted to ask to both of our panelists. But please go ahead, Farwa.
Yeah, so the question directed to me, and it comes up a lot, is the responsibility of Southern governments or governments in the global South. And I think this is actually a very loaded question, because what we're really, on the one hand, of course, these countries are elected by their citizens and represent represent their citizens, and therefore they have the mandate and the responsibility to ensure that debt incurring instruments or instruments that actually erode the sovereignty of decision making or policy making or developmental state in the country is not compromised. At the same time, the definitive point here is that they are the global South and there is a global North, because we have a continuity of colonial and imperial relations which subordinates them and which puts them in that place. So this is not to say that they don't have a responsibility in saying no or rejecting certain offers which are on the table, which are not in their interest. But this is actually looking at the lack of a bargaining space in the international financial architecture and looking at the options they have. So if you have a diversification of donors and investors, I think that's a good thing, because you don't have a linear agenda. Unfortunately, the majority of the wealth is concentrated in the north. And if you are a global South country, then basically you don't have any power. So we start with the point of view of powerlessness, and then we look at this situation in that context. I mean, as you know very well, that almost 54% of countries now are in a severe debt situation, and most of them are based in Africa. And what, I mean, so instead of just talking about this, we have to question what are the drivers of this change and why is it happening? And also, just with public-private partnerships, there is a very political aspect to blended finance, which is that you as a government say yes, and you run for like 5 years or 10 years, but actually the privatization, the user fees of energy, of roads, of bridges, of whatever climate neutral infrastructure that happens is ultimately paid after your time. So it's a long-term contract, and previously public utilities are privatized and you become from a citizen to a consumer. So blended finance actually is a very long-term instrument which has very, very long-term implications, and that needs to be the way of seeing these instruments. And of course, there are hidden liabilities, there are contingent liabilities. What we see in terms of a contract is not simply a contract for blended finance. It's about how that certain project integrates with different sectors in the economy, how it inflates prices of goods, how it affects a sectoral mix in your economy. So especially when we talk about green transition and energy transition, it's not simply about the whole grid is going to become carbon neutral and so on. It's about how it also develops on existing fossil fuel technologies and perpetuates that. And I think South Africa is a very interesting example in that sense, because it builds on all these aspects to then have something which is called green. So all of these things have to be considered when we talk about any instrument of private finance, and to see it from a more political economy perspective rather than something which is ahistoric, very technical, and would bring XYZ results, which is how the whole development agenda right now is formulated. I'll stop here.
Thank you. And I am aware that we're a little bit over time and we have so many questions that we could talk for a very long time. But I wanted to just have some final thoughts maybe from both of you, both in general on blended finance for climate action, anything that hasn't come up already, but there are two specific issues that have come up in the questions as well. One is about whether there's a way for blended finance for climate action to be done in a way which doesn't exacerbate existing debt crisis in especially in lower income countries. And the other one is around if there's a way to drive more investments, to use blended finance to drive more investments towards community-led projects and smaller ticket sizes. We have talked about how most of the money currently goes to big projects, big international corporations. Is there anything to be said for how blended finance models could be used to actually drive more money towards smaller ticket sizes, especially community-led projects? So the debt issue on one hand, and maybe more money towards smaller scale projects. I'll start with you again, Farwa, and then go to you, Basani. And remember also to add any final words if you want to.
Yeah, thanks, Anders. I mean, this was actually the center of our thinking when we were looking at the report, thinking of what could be reformed and how, and actually also being very conscious of the fact that you know, some things need to be reformed structurally, and instruments can only go so far. So one of the things, of course, we said was that you know, if you can demonstrate the additionality of blended finance, if you can demonstrate the fact that actually you know, X amount of private finance has been mobilized and it does not incur debt, it in fact empowers SMEs, for example, then I guess there's a developmental and a business case for demonstrating that. Right now, actually, our critiques are very basic. We're saying, A, the private finance has not been mobilized. B, there is no additionality, and why are you bringing the private sector on board? So this has to be established. And finally, in terms of alternatives, yes, I think SMEs are a good starting point. And again, it's about long-term job creation. It's not about 5 years. It's about ensuring that you know, the structural diversification of an economy is taking place through certain interventions. And you know, while saying that, we were really clear in terms of, at least from the point of view of climate finance, that blended finance should not be used in the loss and damage fund. And what is the responsibility of global north countries should remain that, a responsibility and not an opportunity for private investments to come in and build on profits. So there has to be clear cutoff points. There has to be a strong regulation, both in the global north and in the global south. But most importantly, I think blended finance has to first demonstrate its efficacy. We cannot just speak about a financing gap and just say private investment unless we see results. So far, I mean, I think the last time I wrote a report with people was like a couple of years ago, and maybe in 20 years. So far, we don't see the evidence. So I think it's incumbent on DFIs, on investors, on these collaborations to make the case for blended finance. I'll stop here.
Yeah, I mean, I have very little to add there, but just to kind of emphasize Farwa's point on the additionality aspect. I think this is very key. I think that additionality has not been demonstrated, rather it has been pronounced. So even in the JED IP, before we got a sense of how the financing mechanisms are going to work, there was this, they did say that economic diversification, we're going to ensure that this happens. We're going to ensure that labor workers are included and that the transitional risks are managed, all of that stuff. But when it comes to where the rubber hits the road in terms of where these the money is actually going, you don't actually see that level of additionality. And then, so the question is, how is the additionality part of the discussion when these financing models are being done and the project is hitting financial close, right? How is that whole mechanism? What is the process of that mechanism in ensuring additionality? That is something that requires, as Farouz says, the development finance community to really work out, because it's through their money that this whole thing is being injected.
Great. Thank you very much to both of you for your answers, and thanks for those who have stayed on. I know we've over time, and I also noticed we actually had quite a few questions that we didn't have time to address in this webinar. It's always hard to know exactly how much time to allow for Q&A in a webinar like this, but I'm really glad about the engagement, and I can also see from the questions that there's a very high level of knowledge among the participants on this call about this issue. So please add any additional questions that you have in the Q&A box, and we will try to reply to them. There's also been some suggestions about people who want to follow up online, and please also feel free to do so. And if you haven't already done it, please do have a look at the report that was published earlier this month. It's in the chat together with also the case studies. With that, thank you very much for your time, and thank you especially to our two panelists, Farwa and Basani. It's been fascinating listening to you, and I hope that everyone feels that they have learned something and had at least some of their questions answered. So thank you very, very much, everyone.
Thanks for hosting, Anders, and thank you for everybody for attending.
Thank you, everyone.